Hello, everyone, and welcome back to the all-new Blueprint strategy course, and welcome back to Module 3, Fundamentals for Market Setups. And welcome to the final lesson of this module, Lesson 3, which is seasonality, or what we will call true seasonality. The Bible tells us that there's a time to sow and there's a time to reap. And that is also true when it comes to the world of trading. If you come to think about it, we eat a lot more meat or beef in the summer because of barbecuing and parties and good summer weather. So prices tend to be higher then. And of course, the classic example, heating oil tend to rally in the wintertime because we have cold weather. And therefore, we can just assume that there are seasonal influences on what drives price. And in fact, there are a lot of markets that show some very strong and dominant seasonal time periods, or what we will call seasonal patterns. Or in other words, there are certain times of the year when certain markets are most likely to rally or decline. If you want a really thorough lesson on seasonality, then I'll show you where to catch up on that. Because what we are going to do today is we're going to go through our indicator, both the true seasonality and the Radarscreen. And I'll show you how to create a workspace to study seasonality. Now, on the OTC Futures course, within your classrooms, under Module 5 Expert, you'll find one lesson, Lesson 3 also, which is seasonality. And here you'll find a very comprehensive course on what seasonality is. In very basic terms, true seasonality will help us in identifying dominant seasonal time periods or seasonal reoccurring pattern. And there are a lot of people that claim seasonality to be the holy grail. We don't, okay? Seasonality is an invaluable tool, but it's not the be-all, end-all. Yes, usually markets tend to rally and decline about the same time every year, but not necessarily. I wish it was as easy as that. Therefore, what we will find using our seasonality tool is that there are these seasonal patterns, and what we will use it mostly, we will use it as an additional layer to get a better understanding of the underlying fundamental condition of the market in terms of answering a very specific question. We're answering when we are supposed to buy or sell. If you look at this iceberg analogy right here, all of our tools and all of our sub-strategies, if you will, they're here to answer very specific questions. They may be answering more than one question, but all of these tools are powerful at answering some questions better than others. So what we've learned so far is that the COT and the valuation, those are fundamental setup tools. Those are fundamental setup tools because we're answering what can we expect. I'm really emphasizing what, okay? Can we expect a major rally or can we expect a major decline? So what can we expect? What's the fundamental setup? Are we bearish or are we bullish? So what are we trying to do? What do we expect in these markets? That's what we use the COT for our finite markets for, and that's what we use valuation for our infinite markets for. So we're asking what? True seasonality doesn't really answer what we're expecting. True seasonality is answering when we're expecting that move. So if we're bullish and let's say the COT, the commercials are accumulating and they're at historic highs and we're really bullish, then we can say, well, we're bullish, but we know this is not a timing tool. This is more like a setup tool. So the question that's left answering is, well, when is it most likely for that move to take place? And that's what we will then use seasonality. So seasonality is then an additional layer or an odds enhancer, if you will, to answer when we can expect that rally or that decline to take place. So far, just looking at our indicators, we're answering two questions. What are we, bullish or bearish? And when are we bullish or bearish? Ideally, those two are going to be aligned. Now, the question that's then left to answer after the what and the when is, at which price are we going to buy, right? And what's our risk to reward proposition? Well, where, in terms of price, are we going to buy? So we have a what, a when, and a where. The where, that's what we use our higher time frame technicals for, right? We use our supply and demand to answer where price is cheap, where price is expensive. And therefore, when price is cheap and the commercials are buying and we are seeing a true seasonal pattern approaching that's bullish, well, we've got the all stars aligned scenario and we are going to buy that specific demand zone with that fundamental setup and the fundamental odds enhancer of true seasonality. So when we analyze our tools, we're always asking different questions. So when I look at true seasonality, I'm not necessarily, and I'll write down some rule cards later on with you guys, but when we look at true seasonality, we're not necessarily arguing the magnitude of the move that we expect, right? Are we, with true seasonality, we're not arguing, are we expecting a major rally or a major decline? The magnitude of the move, we're arguing by looking at the COT or the valuation, depending on whether we look at finite or infinite markets. There we can see, hey, we're undervalued on Apple, we should buy. When's the best time to buy? Well, maybe January this year and then October and November again this year. Those are the best times to be a buyer. And so we align ourselves with the true seasonality. All right. So what we are going to cover today is we're going to cover a true seasonality and Radarscreen workspace. And I'm really going to show you how you can study this yourself. And then I'm also going to talk about the yearly roadmap, which is also a way of using seasonality. That's a yearly seasonality, very different to the Campus True seasonality or the seasonality Radarscreen. That's specific to stocks. So if we have time today, we can also talk a little bit about the yearly roadmap, which is then only applicable to stocks, while the true seasonality is really applicable to all of our markets. And that's why it's also such a powerful tool. So I'm going to create a new worksheet, and I'm just going to paste one window into this worksheet right here. Okay, so what true seasonality is showing us the best opportunities that are coming up in the market. And therefore, we know in advance when these markets should rally and when these markets should decline. So why do we call it true seasonality? We call it true seasonality because it's updated every day dynamically. And it's based on the real underlying futures data. And it's also not calculated on calendar days, what most seasonality tools out there do. Ours is calculated on trading days of the month, which shows a lot more consistency and accuracy over the years. And therefore, what we can do, and what that white line does here in my window, is we can always project the most up-to-date and relevant future projection of when the next major seasonal lows and highs take place. Let me repeat that once more. We can always project the most up-to-date and relevant future projection of when the next major seasonal lows and highs take place. So let me remove everything on this window. Okay. Here we go. We can use seasonality on a daily as well as on a weekly time frame. The difference is on a weekly time frame, you look at weekly bars, and therefore you'll get less zigzag within your seasonal pattern. And on a daily chart, you'll get, it works on daily bars, so there's going to be more zigzags based on your seasonal pattern. Because if you look at the week open versus the week close, you don't necessarily have these lower time frame highs and lows, and therefore it kind of smoothens out the curve or the pattern as we look at the weekly seasonality. But we can look at both. I'll show you how to do that. So right now I'm just looking at gold daily chart, and what's going to be important, since we're going to look at a future projection of price, we will need some data, some space to the right. You can see right now down there on the X scale, on the date scale, you can see I'm roughly going to June. I may want to go further into the future. If I want to project more data into the future, and I can project up to a year into the future, then I also need to add more space to the right. Now I'll show you how to do that. If I'm going to double click on the black space here, then you can see space to the right, 25. So at the moment, I'm showing 25 daily bars to the right. I can go up to 150 bars to the right on a daily, which then you can see now we can see a lot more dates that are showing here as a reference into the future, which will then help our indicator to also plot the lines. What we'll also need is we need a lot of backdrop of data, because if the data is not loaded into the chart, we also have no way of measuring or calculating those averages. So what I need to make sure is that I go to time frame, customize, and that I have at least 25 years of backdrop of data loaded. This will allow the true seasonality to do its calculation, even if you look 15 years into the past. So I press OK. And now, after adding space to the right, to be able to plot the lines. And after making sure I have enough historic backdrop, I can now load in the true seasonality. So I'm going to go to studies, add study. Here we go. And then we can have the true seasonality v1.1 protected v1. That's the one that you should have access to. Press OK. And now you can see that you get a blue line plotted below your chart. Now, eventually what you're going to do, and what I like the most, is to have it plotted within the same chart. And I'll show you how to do that as well. But for today's exercise, I want to keep them separate. Okay, I want to keep them separate. So now we get our beautiful lines plotted right there. And if I'm going to double click on this indicator, I can change my inputs. So right now I'm referencing a 5-year seasonal pattern. Okay, I could look at a 10-year seasonal pattern. I could look at the 15-year seasonal pattern. Heck, I could even look at a 20-year seasonal pattern. And here I can project the number of bars into the future. So here I'm basically saying how much future do I want to have plotted. So I could, since we loaded 150 bars to the right, I could project up to 150 bars to the right here as well. You can see now this would be even plotting all the way to here. So we know, by now we know what to expect. We know that vertical line, show date. We know that in mid-July, we're expecting a bullish seasonal pattern that stretches all the way into end of August. What do we know next? Well, next we know that from mid of August, we expect a seasonal decline all the way into September, October, after which maybe we get another rally, after which we maybe get another decline. And then we're talking about Christmas time, and from Christmas time onwards, usually what's going to happen is you'll see a mirror of what happened here in December. We get a major rally, and this is one of the seasonal patterns that we really want to talk about, because that is the seasonal pattern that's most accurate to any market that I know, that I have experienced. Okay, so this is something that we'll also write down eventually. But for gold specifically, the time from December stretching all the way into February and sometimes even longer, this is the most consistent seasonal time period of the year for any market that I'm aware of. Second best is the October-November rally for equity indices, also very powerful seasonal time period of the year for equity indices and stocks. So these two are very powerful, but there are a lot more seasonal pattern that we can use. These are just very, very strong examples here. So what I want to look at here with this tool is I really want to look at the seasonal highs and the seasonal lows. Okay, I don't care so much about this. I don't care so much about the squiggly lines, right? About zigzags, because if I get zigzags or squiggly lines, it's very insignificant, the average over the years. We could have some years very strong, some years very weak, or maybe the average year is just, basing We just don't know. But what we do know is that we get a steep rally or a steep decline without a lot of zigzag taking place in between. Those are very strong seasonal patterns. And this is really what we should be focusing on. So this is a very good example. 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 This is a very bad example. And this is a very bad example, right? So we will not find clear seasonal patterns for a certain market all year round, right? We have to focus on the times where it's very significant, very accurate, and very clear. And here you can see two very clear bullish examples, two very clear bearish examples. And as I'm dragging this to the left, you can also see that the magnitude of these moves, the scaling adapts, right? So what you never want to do is you never want to play around with this here. You never want to play around with the scaling here, because this will mess up the automatic scaling range. What you always want to do is you just want to drag it to the left, and you want to have it automatically scaled. What's also a very good example here is, of course, this time period is also very strong and dominant, significant, very good example of true seasonality. So we have now some very strong examples to the upside and some very strong examples to the downside, and then also some very weak examples. And I would even call this a very weak example, right? Everything kind of in between all this, these zigzag lines, they're rather weak examples of true seasonality. At the moment, it is worth mentioning that we're looking at a 10-year seasonal pattern, okay? And at the same time, what I want to do is I want to really note down some rule cards. The first rule card is that strong seasonal patterns are 5 years, 10 years, and 15 years. Now you may ask, well, what's the strongest? Which one should we focus on? I wish I could tell you. What I can tell you is that we want to look for overlaps on the major seasonal highs and lows. Okay, so how can we check if there are overlaps? Well, what we can do next is we can just go to studies again, add study. It always opens to the left here. I'm just going to add this tool once more, and you can see now this is added right to the bottom here. And this is now showing a 5-year seasonal pattern. So I'm going to change the color of this in, well, first of all, I'm going to look at 150 days into the future. So I also have the same days here. And I'm going to look at 5, and I'm going to change the color of it just so that we are aware that this is a different seasonal pattern. And maybe let's make the lines a little bit thicker just so we can see as well. Okay. So now I have a 5 and I have a 10. What we can see is that those true seasonal periods here, for example, we're getting the same whether we look at 5 years or whether we look at 10 years. Here we get the same whether we look at 5 years, at least from here to here, we get the same whether we look at 5 years or we look at 10 years. From here to here, we get mostly the same whether we look at 10 years or at 5 years. And so that tells us that the seasonal pattern is reoccurring year after year after year, and that there's a high significance. If I was just looking at the 5, then I'm not really sure if there may have been one year that is an outlier here somewhere that may have caused the markets to, that may have skewed the average a little bit. But if I see that, hey, I can see that on the 10 year, I can see that on the 5 year. Hey, it's not just, it can't be an outlier. It has to be consistent rallies that are taking place over the years, regardless of what average I'm going to look at. And so now we look at the 5 and the 10. What I can also do, just add it once more. Now we're going to look at the 15 one. And what I'm going to do is, again, change the bars to the right, change the color, maybe to green, and just make the line a bit thicker. Here we go. And now I can potentially align also, well, what's going to happen if I look, again, 5 years further into the history versus the 10 year. So here I can see on the 15 year, it's more like the best pie point starts to be here, just one day before Christmas. That's always what we pray to you guys, just before the Christmas time. One day before Christmas is when we want to buy gold. What about the other seasonal patterns? Here to here, it's very accurate on all of those. We can see that also within the chart displayed here. Also this year, we got a nice little rally up just in price. And then also here on the 15, it's not as, doesn't seem to be as strong as for the 5 or for the 10, but it's good enough, right? And then where it gets tricky is on the bearish pattern. And now we can see that on the bearish pattern, only the 5 and the 10 show some clear bearish movements. And on the 15, we don't really see that. So if we were just to look at the 15, and if we weren't to look at the 5 and the 10, we may be missing that there may be some new seasonal pattern in place that has recently formed, and that may be accurate as we go forward into time. Okay, so what then we can also do is I could now go to time frame customize and scaling, and now my symbol I could hide. Okay, if I'm going to hide my symbol, what I can do now is I can make those seasonal charts just a little bit bigger. I'm going to remove those drawing objects just for now. And what this will now allow us to do is for each product going forward to really study the best times to buy and the best times to sell. And what actually makes the most sense is if we start at 5 at the top, and then maybe we have a 10 here, and then we have a 15 down here. So if we are, for example, right now Bash, you're asking, what is the scaling I just did? The scaling in terms of just adding more space, in between the candles. So pressing up and down on the keyboard. You mean that? Or removing the chart itself? Okay. On the indicator itself, the scaling should always be on automatic scale range. It should always be on automatic. Never have it fixed, always have it on automatic. The minute you play with your price axis here, the minute you play with that, it messes up with the automatic scaling range. So if I'm now going to click on that again, you can see it's now moved to fixed. So you never want to play with the price axis. You always just want to press up or down and then move either the chart forth and back and let it auto scale. And what you may want to look at is half a year maybe of data, and then you'll get a very nice picture. So if we are in May at the moment, mid-May, now we could argue, well, what do we want to do? Maybe not so much, right? Maybe not so much. Well, is there a time that's approaching where we may want to do something? Well, just based on the true seasonals, I would argue that the best true seasonality that's approaching, the best pattern that's approaching where we have an overlap here, is the 18th of July. So on the 5-year, it would be the 14th of July. On the 10-year, it would be the 18th of July. If I put it on the 18th of July, I have a very accurate overlap on all of those seasonal patterns, and it stretches at least into August. So I have 2 to 3 weeks of beautiful holding, buying gold in this example. So I know that this right here is going to be a buy point for me. And this gives me a little bit of a roadmap in terms of, okay, when should I be buying if I become bullish in the precious metal market? And when should I be selling if I become bearish in the precious metal market? And that's roughly from the end of August. From this timestamp, from here onwards, I should be selling. So now I have a little bit of a roadmap, best time to buy, best time to sell, very significant periods of time on cross pattern, on cross yearly pattern. And so now it's important to note that what we mentioned before is that even though the magnitude may be big here, it may not necessarily play out that way. Okay. Again, we don't use true seasonality to argue magnitude. We just argue when potentially are better or the best times to be a buyer, and when are potentially better or best times to be a seller. Okay, this is what we're arguing. So that's very important to write down. So seasonality is not indicative of the amplitude of the move. Rather, the COT or valuation would be better for that. And also, seasonality argues when are better or best times to be a buyer, and when are better or best times to be a seller. So we, within this analysis, found both. Okay, we found in gold the best times, the better or best times to be a buyer, and the better or best times to be a seller. Buyer right here, seller right there. Now we're going to copy our Radarscreen into the same window. Arrange all. And we will link them. These two are linked already. So that means now that if I want to find the better or best times to be a buyer and the better or best times to be a seller for the Dow, I just click on the Dow, and now I can study the true seasonality. So already what I can see here is, ooh, what is this rally that is coming up? What is this seasonal low that is coming up here? Well, this is starting from end of September, October, right? So if I look at the 5-year, it already starts in end of September, also aligned with the 10-year. If I want to align it with the 15-year, then I have to go to the 9th of October. Also here, probably very much aligned. So that is the best time for us to buy when looking at the Dow Jones. So already I know I can write this down. I can have my vertical lines here so that when I look at this, I know exactly that on the 9th of October, in October, all the way to year end, you want to be buyers, right? It's the better or best times to buy the Dow Jones. We may be asking, well, what about wheat? So I could now do the same thing. Where are we in wheat? We're in May. What do we expect to happen? We expect maybe a little bit of a rally, and then there should be a very sharp decline from June onwards. Very bearish seasonal pattern, very bearish seasonal time frame where all the years, the 5, the 10, and the 15 are aligned, which make this a very potent, a very significant or dominant seasonal pattern because there's alignment regardless on what average you take a look at. And it also, I like it the most if also the 15-year one shows the same one because it means that this has been existing since forever. And very likely, there's a fundamental case to be made here that there's a seasonal pattern in place for a fundamental reason that we just don't know, because we don't know the ins and outs of what, what drives wheat prices fundamentally apart from commercials. So if during that time in June, the commercials are distributing, then what are we going to do? We're going to be big time sellers. Where are we going to sell? We're going to sell in supply. So what commercials are selling? Great. We want to sell. We're bearish. When? June seems to be a very dominant seasonal pattern. Great. Gives us a roadmap, stretches all the way into July, gives us some time as well. And then at last, where are we going to sell? Going to sell in supply. Now, lastly, what we can do now as well, and maybe let me add a new page here. I'm going to call this Radarscreen. Okay, so there's going to be different ways on how we can also set up a Radarscreen now. And I'm going to show you what a Radarscreen really is. Let's start with gold, because gold we just looked at. You want to right click on the studies, edit all studies. And what you want to do is you want to remove all of that nonsense. And what you want to add is you want to add the Campus True Seasonality Radarscreen V1 right there. Okay. So now you can see this little red dot there. This means that if you see a red dot here, it means that you have to change your time frame on all of your symbols to daily. Okay. So now you get a TDOM 1 right here. This refers to the first trading day of the month, whatever the month is that we would be looking at. I could add another @GC here, and now you can see it automatically populates a 2 here. You could also click on this, Control C for copy, Control V for paste, and you could see we get 4, 5, 6, 7, 8, 9, 10, all the way to 23 before it then starts at 1 again. This means that there's up to 23 trading days within a month. Remember, these are trading days. These are not calendar days, okay? We're not looking at 30 calendar days. This would be very deceiving if we look at seasonality, because what if that falls over on the weekend? We look at the trading days, and there are up to 23 trading days depending on how long that month is specifically. So these are your trading days of the month. They're stretching from 1 to 23. They're auto-populated, and then they'll start at 1 again. That means that now I could look at silver at SI. Oops. And I also get it populated for silver just below, right? And then I could look at palladium just below, and then I could look at copper just below. And so right now what I'm building is I'm building a Radarscreen for GC and silver. And there's many various ways on how you may be playing around with this radar screen. I'm just giving you some examples on what you can do, and then you can go all out on it and create whatever you want to create for your favorite markets. Now you want to go to studies. Well, first of all, I may be aware that you can see you may not be able to see this very well. So let's go to settings, page, and let's just make the headings and the grid values just a little bit bigger here. Otherwise, you probably don't see this very well. Okay, so now on the top, you see M1P1, M2P1, M1P2, M2P2, M1P3, and so on and so forth. What you want to do is you want to go to studies and edit just our true seasonality indicator. And here you get exactly those inputs. So we're getting the months 1 and the months 2 that refer to M1 and M2. Okay, months 1, months 2. So we could always look at 2 different months back to back. For the most part, we only want to look at 1. Okay, so for example, what months do we want to look at? Let's say we're closer to July. Okay, we're closer to July, and we really want to find the best entry and the best days for us to be buying in July based on this very bullish and dominant seasonal pattern right here. So what we then would do is, we could do this for every month, is we edit the studies, we put in a 7 for July, right? Because this is a July. So we want to really look at the month of July. We don't really care about the month 2. We will hide this in just a second. And then here I can see years back 1, years back 2, years back 3. These are your P1, P2, and P3, basically your seasonal patterns, 5-year, 10-year, and 15-year averages. You could look at 10, 15, 20 as well. Doesn't really matter. And then at which point do we show a green at 60%? So basically what we're going to do, I'm just going to tell you in a second. Let's just fix this right here. And then we're going to hide all the P2. So we go to data, we go to studies, show and hide plots. All the M2s we're going to hide. Studies, show hide, all the M2s we're going to hide. And then again, all the M2s we're going to hide. So now we're looking at July. And we're looking at a 5-year, a 10-year, and a 15-year pattern. Okay. So what we can see now is that the first trading day in July, there's a 67% likelihood of that day to close bullish. Okay, what does 67% mean? In this case, it means that 4 out of 5, or sometimes 4 out of 6, depending on how many years it fetches, can be different. Sometimes it fetches 1 more or one less. That's a problem due to the trading days. As we don't look at calendar days, we look at trading days. So sometimes it catches 1 year too many, or 1 year too less. And so sometimes, as you look at the percentages, you're like, okay, 62. If we look at a 10-year pattern, right, then a 62 doesn't really make sense. It should be a 60 or right, a 60, then it would be 6 out of 4 years were bullish basically. And sometimes it fetches 1 year more or less basically, which then gives you odd percentages. But the point being here is that where you see green clusters, this is what you want to focus on. Okay, where you see green clusters, this is what you want to focus on. So let me just check something real quick here. If I fetch the right one. Let me try and fetch this one instead. Oops. You definitely have the most up-to-date version. I'm just not sure if I have just loaded the most up-to-date version here. So let me just check. I have so many of them. No, it's not the one. The problem with TradeStation is it doesn't allow me to increase this box right here, which is super annoying. So just hang on with me for a second. Here we go. This is the most up-to-date version. So let me remove this. So you should see the same numbers as displayed here. So let's just quickly go through this again. We are hiding the M2s. And editing the inputs, we're looking at July 5, 10, and 15. Here we go. This looks a lot better now. So now we're looking at July. We're looking at 5 years, we're looking at 10 years, and we're looking at 15 years. And we're looking at how many of those years are bullish days, green days, versus how many days of this month are within that first day, second day, or third day are bullish or bearish days. So this is a measure of whether that specific trading day of the month was bullish or bearish. So when we see green clusters, like here, for example, we get a 60, 60, 80, 80. On the 5 year, we know that based on the last 5 years, there were mostly bullish days for gold in July. But where it really catches my attention is towards the end of the month, starting maybe from the 16th, we're getting 80, 60, okay, one bad day on the 18th, but then we're getting 100, 100, 100. And also on the 10, it's pretty high. So towards the month end, it looks a lot better than in the beginning of the month. And so if we also go towards month end, then we also see from the 18th, this also makes sense, right? From here onwards on the 5, we're getting these very straight lines up. So that makes a lot of sense that also most of the days, if you were to look at the past 5 years, were in fact bullish. And if you looked at the past 3 trading days of the month, the last 3 trading days of the month in the last 5 years, you know, they were mostly green candles. So very good time to be a buyer in July. When would be the best time to buy? Maybe somewhere in the beginning of the month or somewhere towards the end of the month. Maybe not so much towards the middle of the month because there's not really a green cluster. The green cluster is either in the beginning or in the end of this month. And we also see for silver in the past 5 years, I was looking at silver here. For silver in the past 5 years, I get very consistent rallies every single day. Okay, so the July is very good. And in terms of then picking out the best day, the earlier the better, right? In this case, there's not really a green cluster that we can work with because all of this is basically green. And so there's not really better days than others. Well, there is the 80% days, the 10 and 11, and the 15 and the 16. So these seem to be here also 90% on the 15-year, the 10-year average, so 90% here. So these seem to be very, very accurate days to be a buyer. 15th trading day in silver, what do we want to do if we find a lower time frame demand zone? Well, we better want to buy this, right? So this is one way of looking at this. We can pick out the days that are the best. What if we're on the 19th trading day for gold in July and we get a little bit of a dip in gold? Well, we better buy in demand, right? What better days to buy than on those days where you see a very high accuracy in the past that we got consistent rallies. So if in the past 5 and in the past 10 years, on the 19th and on the 20th trading day of July, I got 7 out of 10 rallies, then this is a very consistent time for market rallies. And so it makes sense that when it gets to those trading days, when we get closer to those dates, we definitely want to buy daily income zones. In terms of the true seasonality, what it will tell us, the true seasonality will tell us potentially bigger setups. And then the radar screen will potentially tell us, okay, can we zoom into this and fine tune based on maybe a lower income trading strategy, a day trading strategy? When are the best times to buy within that very bullish cycle, within that very bullish pattern? So within that very bullish pattern, I may be buying in the beginning of the month, and even better towards the end of the month is even a better time to buy gold or silver. So this is one way of looking at it. And, you know, we could add the S&P here as well. And really that list could be as long as you want it to be. So now we're looking at S&P in July. Whoa, look at this 100% rally on the 3rd of July based on the past 5 years. 8 out of 10 on the third day in July, 60% on 15 years, do the math. Not so great on the past 15 years, but very accurate on the 10 and the 5. So very good time to be a buyer here in the beginning of July. Very, very bullish. Let's see if seasonality will display the same. Let's go to July, June, and July right here. Yes, look at this. Beginning of July right there, end of June, and then we're in July. Very consistent market rallies. And of course, we get those green, beautiful clusters. So we better be buying the S&P in July. So we're now obviously looking in July. We don't really care about July right now. I'm just trying to make a point on how to study this. But what you would do is right now we are in May. So you would look at May, and or if you are prepping for the next month, you would look at June, right? And then you would just change your M1 to June. And now you would get all this data for June. And then you see, okay, the first trading day on S&P, let's stay away from the S&P. But then from the second trading day of the next month, we really want to start to buy, maybe for 5 days or so, look to take some profit and then reevaluate. And then towards the end of the month again. And that's very powerful. Towards the end of the month in June, we get a very high accuracy again. And we just saw that in the beginning of July, we get a high accuracy. So maybe we shouldn't position ourselves in the beginning of July. Maybe we should position ourselves towards the end of June. And to do all of this, there's even going to be a more powerful tool, which is the trade optimizer, which we'll only introduce later on in this course. But this is a zoomed in version of the true seasonality, which is based on days, weeks, months. And here we can really see the big picture. And within that big picture, we can then zoom in and look at each trading day and the percentage of that trading day to be bullish or bearish, to then potentially also fine tune the trading days, look for a better when, and look and introduce this to our daily income, or even what Toby is doing for Forex, which is a hyper trading income strategy, where if you have 100% day on the last day of June, then if you want to buy a 5-minute zone, then you better buy it on the 22nd trading day of June, right? You wouldn't buy that on the 14th trading day of June, where you get consistent red candles here. Rather, what you would do, you would look to sell, right? Or on the 7th trading day of June, rather what you would do, you would look to sell. But you would buy on the 2nd, you would buy on the 3rd, and ideally you would buy on the 2nd and hold on for a few days, because this is a green cluster. Again, most powerful are the green clusters. When you see the green clusters, that's really when you want to pay attention to this radar screen right here. So Bash, you're asking, why are you stopping at 23 days? Well, how many trading days are there per month? If a calendar day has 30 days, or maybe 31, and then you take away the weekends, right? Then you end up at maximum 23. It's not possible for a month to have more than 23 trading days. Actually, most have a lot less. So for example, on gold in June, I believe we're looking at now, there's no 23rd trading day, right? So it will show NA. And also here it will show NA. Yeah, it will be max 23. And then if there's no data to be fetched, it will just also spit out NA. So that will depend on the month itself. So what you're doing, basically, you would be counting the candles, right? You would be counting the candles. So this is one way of looking at the radar screen. And this is a market-specific way to really understand and study a market of looking at the radar screen. But we could also use the radar screen to get a glimpse of the entire market overview or our watch list. Let me show you how we could do that. So let's add a new blank. So let's create a radar screen for our watch list. Okay. So what I'm going to do is I'm going to copy all of our watch list. And let me just quickly make this bigger again. I'm going to remove the headers. It's very important. Well, actually, I wouldn't have to in this case. I wouldn't have to remove the headers. In this case, I really don't have to remove the headers. Let's just leave them in. Okay. So now again, studies, edit all studies, remove all this nonsense. We don't care. Add our radar screen. Okay. We see the red dot. What does that mean? Well, we need to go on a daily time frame. Okay, it's loading. And what you can see now, right, there's this default setting of, okay, it's going 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 14, 15, and so on. And then it starts from scratch. And I have these headers in between, which means they also we're counting rows here basically, which means this layout here really doesn't work for me the way I want to look at this. So let's say, for example, where are we now? Today is the May 17th. So the May 17th, we need to check what trading day we're in at the moment. So how you would measure that is you would go to the first trading day. So we're on the first trading day right here on the first. So 1, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So today's trading day is trading day 13, and tomorrow will be 14. Now, what you have to really keep in mind here, and that's a TradeStation bug, is that if you go to time frame customize, the radar screen will always be based on your local time. The radar screen it will be impossible for the radar screen at the moment to display exchange time. Now, if you're based in the US, then anyways, you're based around a time zone where your local time zone is the same as the exchange time zone. But if I change this to local, then what you see is if I'm again counting, so this is the first day, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. I'm on also here the 13th trading day, and then tomorrow is going to be the 14th trading day. So local and exchange, they may differ depending on what time zone you're in. Okay, so if you're in Germany or if you're in Australia or you're in Singapore, if you're back testing the results you're getting here against an exchange time frame, and your exchange time frame may be different, your local time frame may be different than the exchange time frame, then also there can be a 1 to 2 day offset of the results, right? So when you want to backtest the Radarscreen, what you want to make sure is when you backtest it that your under time frame customize that you're on local time, okay, for backtesting. So if you for example get 100% accuracy on any of the days, and you're like, hey, let me see if this really is the case, and you're looking at all these days in the past, then you want to look at a local time. And then also that means that my Radarscreen may display slightly different values than yours, just because the local time, the candles may be looking slightly different, but overall the green clusters, they should be very, very similar. And so hopefully we can have one common denominator in the future. And we mentioned this to TradeStation, that we have to have the option here on the Radarscreen to display in exchange time as well, not just in local time. But until that's fixed, just notice and note down that it's always here based on local time, while within the charts, you have the option to choose exchange and or local. And usually we operate on exchange time, not on local time. Okay, so now what you want to do is, again, quickly get rid of the M2s. We really don't need them. There's a time and a place where we may want to look at those, but for the beginning, just to make it simple and to make your eyes get used to all this data, just remove them and edit the strategy. And now here we can put in 13 or 14, 13 for today or 14 for tomorrow. For what month? We're right now in May. So we could look at 13. And so for today, we would see the best probabilities on the day that we may want to pay attention to. Okay, seems like there's not so much. Maybe Euro GBP is quite good based on the last 5 years, but then 10 and 15 aren't that good. So seems like it's very mixed today. Not a whole lot of opportunities here in terms of day trading. Also, I'm on the sidelines today, no new trades. And here you see also potentially why. So every day, or you don't check the day off, you check the next day. So then if you want to check the next day, you just put a 14 here. So now you have the data for tomorrow, what to expect for all the products. You can see the TDM is always put on 14, while here it goes down the list and you see all the trading days for a month. So basically you see the entire month. And here you see just one trading day for 1 month for all the products, which give you just a one glimpse. Okay, do I have to focus on something today? Do I have some greens here? Do I have 100% here? Maybe Amazon is interesting, right? And so if Amazon is interesting, then, oh shit, okay, it's already rallied away. It's gapped up today. Okay, yeah, makes sense that it's rallying today, even though we're supposedly so high up, right? Even though we're supposedly so high up, this is already rallying today, tomorrow, because of these very high percentages. Well, it's been consistent rallies in the past. So very likely also this year around, we're going to get at least one bullish day here in and around those days, right? And so this also, when I look at Amazon and the daily, we gapped up and it looks like this continues to be bullish, even though we're very, very high up in the chart here. So very good example on on Amazon that we just spotted just now, just maybe a little bit too late. And what you really want to do is you want to have a habit of always checking one day in advance, right? What do you want to do tomorrow before you go to bed, when you do your analysis, and then it's the 14th, and you're like, okay, today is come and gone. Let's check what's happening on the 15th. And then you can see, hey, maybe there's something happening on the New Zealand dollar. Maybe we can focus on the Mexican peso, the Japanese yen, maybe on gold, right? Maybe on gold we can focus on tomorrow, maybe on silver. So this already gives you an idea of what you really want to look for, right? And it kind of narrows down, if you are into day trading or daily income trading, it narrows down your window of opportunity. You don't have to screen 20 markets every day. You just screen the markets where you see a high accuracy on that specific day. So Kata, you've got a question. The logic also works for the non-green, therefore bearish numbers. Absolutely, right? Non-green or low numbers then are bearish, because it means that most days are red candles. Yes, in fact, that's true. And your second question, are we just focus solely on the green clusters? No, absolutely. You're absolutely right. It also is true on the other side, that for the dollar on that day, and it makes sense, right? On the euro on that day, it's mostly bullish days, and then on the dollar on that day, it's mostly bearish days. So that very much makes sense. And then if the dollar is bearish on that day, then gold and silver are bullish on that day. It also makes a whole lot of sense. And then the New Zealand is very bullish on that day, again, against the dollar, a bearish dollar. So those numbers, they have to make sense as well, right? And like you said, Kata, if it's a low number, it just means that there are more red candles than green candles. So now you have a Radarscreen watch list. You can screen always the day off or the one day in advance to really wrap your head around what market may be setting up best based on true seasonality. And you have then the Radarscreen entire monthly picture, where you then find within that entire month, okay, where may I be able to find green clusters? So that's then more into, okay, maybe more than daily income, maybe more like a weekly income strategy that's aligned with true seasonality, giving you a very good picture of what you want to do for those specific months and days and years. And then for the years, we would be talking about the yearly seasonality on stocks. What you eventually want as well is you want the true seasonality to be displayed in your window right here. And so you can see, you can also have this part of your daily. And so how you basically can do that, let's do that on the blueprint. Maybe we just copy any window here, paste it. So now we have a daily chart. And now I want to add the seasonality again. and I got an error. And so the error says, this study attempts to reference too many bars to the right of the chart. Please adjust the properties of the study. Okay, so what did I not do? I didn't add bars to the right. I only have space to the right. I only have 10 bars. I want to display, I need a lots of space to the right, right? So I need maybe 150 bars. And now let's try and add that study again. Here we go. Now it's displaying. And in that case, what I really only need is, I may only need 50 days, or 25 days may even be enough if I look at it within the same daily graph, right? Because I only want to see, okay, what's happening in the immediate future. And then I could say, well, maybe have a 10 as default here on this one and change it to white. So it's aligned to our 10 here. So I know, okay, white represents 10. And now what I can do, I can just grab it, drag it up, and then say, okay, use the left axis. And now it's on top of my chart. So now I have a little bit of a better view in terms of maybe shorter term rallies or shorter term declines here that I may have to be aware of when looking at that market. What you then can also do, if you want to put it down again, you can just double click on it, double click on the indicator, and then go to scaling, and then just use the subgraph too. And you will see it comes down again, drag it back up, left axis, here we go, double click, go back down again to 2. And what I've actually done is I've created a shortcut for studies, enable and disable studies, right? So I just do Control A and I can add and remove the study. And so that allows me to look at it on the same window as I look at it here. And then if I'd looked at it and I'm like, okay, I want to be bearish, I want to short, but now I don't want to look at the lines anymore. I can just press Control A, remove it, put in my supply zones here. And okay, do I want to short? This is the other one. Do I want to short here? Yes, I do. True seasonals may be a little bit bearish here. And yes, perfect. Okay, remove it again. So how can you do that? By now you should know how to make hotkeys. So in terms of hotkeys, you can also create hotkeys for I believe it was here. Customize, enable, disable studies. You can see I have a Control A here, which means that if I press Control A, I can simply get them on, turn them on and turn them off without always having to go studies, add studies. And anyways, you don't want to have them layered up in your edit studies group here. You don't want to have lots of the same layered up here. It just means that there's always constantly something loading and it makes your computer slower. So you just want to have your one loaded here, and you want to be able to turn them off and on by just keyboard combinations, right? So now the interesting thing about seasonality is that oftentimes we can see that price tracks true seasonality very accurately. And oftentimes price is doing something completely different than what you would expect from the true seasonality, right? So the true seasonality is not the be all end all. Like here, for example, the rally already starting in October all the way up. And here from October all the way down, the true seasonals were pointing down, but price goes up. So what we have to understand is, well, what is happening in October, so end of September, what is happening in end of September that is overruling the true seasonality? Because that's really important for us to recognize that true seasonality is not, we cannot follow this like, we cannot follow this blindly. We cannot blindfold ourselves and say, well, just because that's the seasonality, I can follow this and make money all the time, right? I wish it was as easy as this. There are fundamental drivers in this market that overrule true seasonality, and that is immensely important for you to note down here. To understand what's happening in the end of September for gold, well, gold is a finite market. What fundamental tool is most important to finite markets? The COT. Who within the COT? The commercials. So let's look at the commercials towards end of September. End of September, 30th of September, right here. This is then October. So we are touching the yellow line. The commercials are touching the yellow line. So what does that mean if the commercials are touching the yellow line? Well, if the commercials are touching the yellow line, what you want to do? You want to buy with the commercials, right? So what we can do, for example, here is let's do an experiment and just drive this home. Let's go back in time to also then include the seasonality and see what the seasonality is telling us at that point. Last year, October. Okay. Last year, October. We are here. The commercials are bullish. The retailers are bearish. This is our fundamental setup. Okay. What do we want to do? We want to buy. Okay. We want to be bullish. We're expecting a major rally to happen, right? Without knowing that this rally is going to come, eventually we know that it's going to come. Well, when is it most likely to come? We would have to look at true seasonality. Now I'm going to show true seasonality on a weekly chart now, because that's also something that we can do. So here we can see that what the true seasonals are pointing towards is they're pointing towards a decline. very, very clearly. And maybe I'm showing too many bars to the right here. That's not necessary. 50 weeks is probably enough. Oops. $50 is probably enough. We look at the 10-year average. Okay. So now I'm looking at the 10-year average. If I'm just looking at true seasonality, then I would say, well, I would be expecting a decline here. But are we really expecting a decline? No, we're not. We would rather expect a rally. When are we most likely to expect that rally? In December. Okay, in December, with the COT being bullish, this is an all stars aligned scenario. It's very clear that we want to buy gold during that time. Let's put them into subgraph 3. So we know that in December we want to buy with the bullish commercials. However, the commercials have already turned super bullish here, right? The commercials have already turned super bullish here. However, the true seasonality would tell us the average usually is down. This is the first demand area, rally base rally, just on the weekly, right? So what do we want to do? We're expecting a major rally. We want to buy. Where do we buy? In demand and with a seasonal low, ideally. And so in this case, if I now go forward a few days, or just 1 month, let's go 1 month. Price is going rallying, and then it's going deep inside the zone. Okay, we're getting closer to our buy point, right? We're getting closer to our buy point. Let's add another month. Now a month has passed, and price is doing what price is supposed to do, right? It's reacting from weekly demand after the commercials have accumulated a heck of a lot. And then we're getting the first rally, even though we're not quite at the seasonal low. And you can also see that now the seasonal low has adjusted slightly to the right. But now what we want to do is we just want to buy new demand areas, right? If we get the chance to, of course. It may be at this stage, we will not get those pullbacks anymore, right? Now that the true seasonality is in full effect, if we're holding on to a trade, we want to hold on to a trade for longer, right? Because this is the true seasonality that we look forward to every year, one day before Christmas, or sometimes already earlier if the commercials are buying earlier. We want to look to buy precious metals, and this just comes around every year. For the last 10 years, ever since I'm trading, this is one seasonal pattern that I've not missed out on trading once. All right, so you always have to look for that specific pattern. Is also why I'm spending so much time on this, because it's one of the most powerful and dominant pattern there are. So now we can look forward again in time. These windows always open to the left here, but it doesn't matter. Let's add another month. End of December. And here we go. We just rally away. And are we done rallying yet? Most likely not. The true seasonals are still stretching for a bit longer, but For sure, what's been created again is new demand. And if price gets into new demand, of course, you want to be buyers at this stage. Customize. Let's go 2 months into the future. 1, 2, end of February. Here we go. Price goes all the way up, rallies all the way up, and then from where it eventually declines. So from this bullish commercial setup, we created a multi-week rally that really was set into motion, not exactly at the true seasonal low, but in and around the true seasonal low. And even though the seasonal pattern was bearish, price still made a turn. Okay, so that's very important. What overrules true seasonality are the commercials and are your fundamental setup tools for the markets that you trade. That overrules the true seasonality. And ideally, you will get the somewhat alignment that in and around the fundamental market setup, you are trading and positioning yourself with dominant seasonal patterns that have a very high accuracy of consistent market rallies or market declines in the past. And so if you look at this time, for example, from December to February, and you go back now into the chart and you're going to say, well, from December to February, what you will find is that most years, December to here, not so much, right? Here, not so much, just a little bit. And then we really got a big decline after. And so if you now look at this, where we got a major rally, and you look at this, and you look at this, and you compare the three, where we would have to argue, well, the seasonal time period is more or less, it more or less stays the same. It changes over time a bit. Here is on the 18th, then it's on the 17th, then it's on the 25th. So it changes over time a little bit, but the overall timings, they're the same, but we don't get consistent rallies, right? Well, here we got a pretty nice rally. Here we got the best rally, and here it didn't work out that well. So we have to ask is, what's the difference between here and here? Well, the difference is here the commercials came from a historic 3-year extreme, and the retailers are caught on the other side, fundamentally bullish, aligned with seasonality. And here, look where the commercials are. The commercials are distributing and the retailers are buying. So what overrules even the strongest dominant seasonal patterns are the commercials, the COT. So the COT is the king in the world of fundamentals. Okay, it has to be that way. And seasonality is not the be all end all, but it's an invaluable tool. It's so helpful in terms of determining a roadmap, getting confidence, understanding when are better times or best times to be a buyer. And you can also see that just because there's a seasonal low doesn't mean that there has to be a low within the chart. In this case, there's none, right? Just because we get a low here doesn't mean we're going to get a low here. Remember what we wrote down? We wrote down, it just tells us the best times to be a buyer. It doesn't tell us this is the best low, and it doesn't tell us this is a higher low or a lower low. It doesn't tell us anything about lows or highs. All it tells us is it's the best or better times to be a buyer. It's the best or better times to be a seller. Doesn't matter if market had already rallied before. Quite the contrary. Write this down. If we, prior to seasonal lows and seasonal highs, if prior to that, the market already takes off in the right direction, then that's an additional odds enhancer, because it means this year around, they are front running the true seasonality for whatever reason. In this case, it was the bullish commercial setup in line with the weekly demand. They're front running the bullish seasonal pattern, which means that in this year, that seasonal pattern is very likely going to work out. And then in that year, we just had the fundamental setup wasn't very good. So yes, maybe we got 1, 2, 3 weeks of rally, but then we just got a decline because the commercials were also selling. And then in that year, when did the market really take off? The market really took off from here to here. And so what's interesting about that timestamp is that here was the time where the commercials became bullish only, right? Only here. And only then, even though we're already towards the end of this seemingly bullish seasonal pattern, right? And yes, from here to here, market kind of rallied, but more like sideways. Here, it only happened towards the end, because here only the commercials became bullish towards the end. So again, it's the alignment, and it's the COT that's king, and then it's the alignment that will make your good trades. And it's very different questions that we're answering here, we're answering here, and we're answering here. Here we're saying, what are we looking for? Are we looking to buy, or are we looking to sell? Okay, we're looking to buy. True seasonality is up. It's in and around that time that usually we see consistent market rallies in. So we want to buy, and then we buy, right? And here we could have said, well, let's buy earlier already. But if we don't want to buy earlier, let's at least try to buy here to make use of that that bullish seasonal time period. And then back here, I remember this time as well, this didn't work out so well. It worked out for a little bit, but this didn't work out as well. And then during those times, we have to ask, well, should we buy it? Well, we can buy it, but maybe let's be a little bit more aggressive with trade management, or let's take quicker profits rather than trying to hold it for a big run up, which for sure, if the commercial's on the right side, then you can hold it for a big run up. You can be a bit more relaxed. While if the commercial's on the other side, you're like, okay, let's buy this, but hey, let's take some quicker profits in the process. So in case of our cheat sheet now, right, when we look at gold, which we just looked at, where is it? Have we never looked at gold here before? I can't believe it. Okay, gold. So what did we say? We said commercials is our primary tool. Of course, it's a finite market. The non-commercials, we don't care that much. The retailers, they're our odds enhancer. And what else is our odds enhancer? the true seasonality, because the true seasonality is great, it's invaluable, but if the commercials, as we just saw, right, if the commercials are not on the right side of the trade, true seasonality is just a line in the chart, right? It doesn't tell us anything. But if the true seasonality is up and the commercials are buying and the retailers are selling, hey, whoa, right? Hold on a second. These are the trades we have to pay attention to. So we could note down that COT is king and that December, January, February must buy. Okay. And if aligned with COT. So for gold, if you want to become a good gold trader, then these are the best setups that you can find. When is the COT aligned with true seasonality, and then the market timing just becomes another topic where you're just going to say, okay, how am I best going to approach this with supply and demand or with price action? And how am I best going to get in and out of the markets based on visual formations, supply and demand, price action, hammer candles, or eventually also the trade optimizer. Just hold on for 1 second. All right, can you hear me again? Perfect. So we did a very quick analysis for gold, and in the future, hopefully we will have time to do a more accurate, a more comprehensive analysis for all of our markets eventually, right? But for gold, what we now saw is that, man, this is the time to buy. COT is king, and we align it. We time the markets with supply and demand, and those are the best tools to use when trading gold, right? And in fact, this is what I do every year, right? And already I'm looking forward to the December time, because we just get consistent market rallies most of the time. And then you just pray that the commercials are also aligned during that time. And then it's a buy, lean back. And we may be wrong with the market timing ones, right? How we approach it. But in terms of forecasting the market, that's some of the strongest setups there are. Now, there's another very strong setup, and this is what we were going to end it with, which is Dow Jones, right? And so for the Dow Jones, we're looking at interest rates, and then we're also looking at true seasonality. Where is it here? We're also looking at true seasonality as an odds enhancer. And so what the most accurate times to be a buyer are for the Dow Jones, we looked at this as well before, right? So if I'm going to go to the Dow Jones, the most accurate times to be a buyer is the October timeframe. Okay, October timeframe. So So if you're going to go to the Dow and then you're like, hey, let's check the Octobers, see how they're holding up. This is October 2022, last year. Wow, right? Look at that. Well, here's where October starts. And so October 2022. Let's see if October 2022. Right, so 2022 on the 5-year, end of October, on the 10-year, end of October, and then on the 15-year, 12th of October of 2022, best buy point. Okay, beautiful buy point. And so, of course, let me get that window up again here. Of course, that was also a beautiful buy point here last year, and most years it is, right? Most years it is. October, also here, beautiful buy point in October, right? Beautiful, stretching all the way into year end. This is 2021. Now let's look at 2020. November, September, end of September, October, then November here was the best buy point. And so you can see that this is in and around October here as well. October for the Dow Jones and for the equity indices in general are just beautiful times to buy. And then, of course, if you can align that with undervalued, and I can already tell you we were undervalued during those times, but of course, I'm going to add our Campus valuation here now. Right, so undervalued in October, you better be buying, right? If you don't buy, if you don't buy here in October undervalued, then the market is not for you, basically, right? So here as well, November undervalued, we just have to buy, right? We just have to buy. Here, we're not quite, are we at 30 or are we at 10? Now look at 10 here. Here we're close to undervalued, but not quite. Nonetheless, October timeframe, major rally in this market as well. So here, this would be good enough, right? And then if here we're overvalued, then we go with our sets of rules, which means Dow Jones, 30 and 10-day cycles, trend following, 13-week cycles buy. So anyways, we only use the valuation for trend following. We don't use it to determine the end of the band. We don't do that. We have shown that it had very low accuracy in our study. And so if you look at this, if we combine it and we're like, hey, we're overvalued within that uptrend, do we really care knowing that it's October? No, we don't, right? We're not. This is not as powerful of a buy as it was down here, right? And of course, you can see the magnitude of the move is so much greater than the magnitude of the move where we get a little bit of a rally and then we get that decline right back, right? Right back to those lows again. And so the magnitude you can see is much better when the valuation is aligned, but nonetheless, we don't look at overvalued when we are uptrending when we're uptrending. So eventually it comes down to aligning, right? Aligning our indicators, and not just understanding, but also aligning our indicators and answering the questions that they're meant to answer, right? For example, I'm not going to look at Dow Jones valuation on a 10-day cycle to then call a counter trend trade. We're just not going to do that. But if we get undervalued in October, November, December, best, must buy, right? And then if we're aligned with undervalued, even better. If not, okay, we know maybe slightly more aggressive trade, but nonetheless, during that time, if in an uptrend, we should be buying. And since we're talking about stocks, we're going to end on this. Since we're talking about stocks, what overrules the true seasonality is going to be the yearly roadmap. And the yearly roadmap is something that you will find only within the stock investor course. And within that, you always find yearly roadmaps where we forecast equity indices and stocks once a year in the beginning of the year. So this was done in January, where we forecasted the market for the entire year, and where we basically said, what are the best times to be a buyer? What are the best times to be a seller? And then towards the end, I think you get a summary. Yeah, here. Towards the end, you get a summary. So in the beginning, blow up rally, right? This is based on yearly seasonality, so slightly different than the true seasonality, because it's based on the decennial pattern that Edgar Lawrence Smith wrote about already in the 1930s, and on election patterns. So this year is the pre-election cycle, and usually during pre-election cycles, markets just tend to blow off from the beginning of the year. So looking at true seasonality, you would have not caught that blow up rally. No way. But this kind of overrules that. And then are we really getting a pullback here? No, we don't, right? So we continue. This continues to go up, up, up. The next best buy point is 1st of June to mid-July. Then maybe we get a little bit of a decline, but then we're straight back to buying from 20th of August to 20th of September. Then maybe a little bit of decline. And then here, this year, expect a low on the 23rd of November only. So again, October, November timeframe, in and around that, for setup for stock market rallies, and that's based on the pre-election cycle. So the yearly roadmaps for stocks play a very important role, because we don't just look at the true seasonal pattern, we look at the decennial pattern, and we look at the election patterns as well, which really play a role. And you can see this year what happened in the stocks, what happened in Apple, what happened with Amazon, what happened with Google. They just blew up from January onwards, right? We just have to look at those charts. They just absolutely blew up out of proportion. And you're like, hey, what happened this year, right? You look at Apple, and this is 2023, right? This is the beginning of 2023, and you're like, hey, what the heck happened, right? And then you go back to what we said in the beginning of the year, which is A, are we expecting a recession? And B, what's the yearly roadmap look like? Well, based on the decennial and based on the election cycle, which is the pre-election cycle, the most bullish time of the year is the beginning of the year, January, February, March, April. So there's not much more evidence to the importance of the yearly roadmap than what I just could show you. But if you don't understand what the decennial is, what the election cycles are, what you really have to do is refresh yourself or watch the stocks course, because there it's all explained. OTC Stock Investor. Watch all those courses here. They're very quick. And then watch the yearly roadmap at last. And then every year we do this yearly roadmap. We also did one for 2022 as well. And so what we have to then write down for these is, hey, yearly roadmap is important. And then if I think we looked at Apple once here as well, right? For Apple here, the yearly roadmap here is really important, right? I have even put a 1 here. It's that important. So yearly roadmap. And that makes sense, right? I mean, if you're predicting that the market is going to go up from January onwards, and you ask yourself about, well, what does the market in terms of the equity indices consist of in terms of their highest market weight? Well, they consist of Apple mostly. And so if Apple rallies, the market rallies. If Apple doesn't rally, the market doesn't rally. So if the roadmap says from January be bullish, then Apple has to be bullish from January onwards, because if Apple is not going to rally, the market is not going to rally. Okay, it's as simple as that. And so, Apple, Google, all of those will play a role there, as well as you look at Amazon and you look at January, and you can do this yourself as well. January, this is the 1st of January, yearly roadmap, buy. And so, yes, of course, right, there's going to be pullbacks here as well, but it tells you to buy. It tells you what the roadmap is. It doesn't tell you where to buy, right? So then you're going to look at demand, supply and demand, to really answer that question, where to buy. All right. So I really like this lesson, because it means we're setting ourselves up to really have these great conversations about markets that we love to trade. And rather than continuing to isolate certain strategies, certain indicators or forecasting tools or technical strategies, rather than isolating them, let's try and figure out how to best use each of those tools for what they're meant to best be used, right? And very important is always going back to the question, what am I trying to answer? Am I trying to answer the what, major rally or decline? Am I trying to answer the when, seasonality? Or am I trying to answer the where in terms of price, supply, and demand? All right, that's it from my side. Thanks for staying until the end. Feel free to hang on and stay around. If you have questions, I'm going to stop the recording here. Thanks again, and ciao.